You must take it step by step, and when you just get into a market, the first thing you need to understand is the direction of the high time frame. Here, for example, we are on the NASDAQ on the daily time frame, and we just do a directional analysis of the swing points this market had recently. And we will see that we start from a swing low, from where the market goes up into forming a high. From this high, the price falls down and ends higher than the last low, before eventually starting to push to the upside once again. So this leaves a low that is higher than the last one, meaning that we've got a higher low. And as I said, from this higher low, the price begins again to push to the upside, but this upside movement fails to continue above the last high, and it ends below the last high, leaving us with a lower high swing point from where aggressive selling begins, and the price breaks to the downside and ends below the previous low, so it ends lower than the last low. Then that means that we've got a lower low swing point. When a higher low breaks down into a lower low, that break is what shifts the trend into a downtrend. That's what we call as a market structure shift. And the point of this trend shift is that if we are entering into a downtrend, that means that we expect swing points of a downtrend, which they are repeated lower lows that are then followed with lower highs. And so if we already have the lower low right here, which was the most recent swing point, as I said after a lower low, we will probably see a lower high coming up. And that lower high is an upside pullback. But this pullback should not be able to break above the last high, because that would be a higher high. But instead, it needs to end below the last high. And that's where entry structures like the resistance or supply level come into help. The theory says that a lower high should end on a supply or resistance. We look for that supply or resistance on the last high, basically on the last movement that caused the recent break or trend shift. The supply level is specific. It's the last upside candle before the market pushed down. But there's the catch. We don't actually trade this supply, but instead we wait for the price to get eventually hit into the supply. So when the price hits it, we know that somewhere around this entire supply level, the price should reject to the downside, so it can continue the downtrend. This rejection needs to end as a lower high, and a lower high is followed with a lower low. So the only thing we know about this possible rejection is that it should end inside of this supply level, but we don't know where or when the rejection should happen. And what we actually do is that we don't trade this supply, but we switch into a low time frame the moment the price hits the supply. So for example, this is the 1 hour time frame of the same market and same price. We're basically seeing in detail the moment the price is hit into the supply from the daily time frame, but we see it on the 1 hour time frame. Now on this low time frame, we also want to do a quick analysis of the recent swing points. And so far, the market is following this pattern of an uptrend. We are not bearish and not going to enter with any setup. A buy doesn't make sense because the price is on a supply, and that means that we would be trading against the high time frame trend. And a sell also doesn't make sense yet because we see the price just going up and up. We only plan a sell setup if the market can break below the last low, because that would shift the swing points and the trend into an internal downtrend. For example, now we see that's what it eventually did. But also keep in mind that a valid break should happen with a candle closing below the last low. And this break below the last low is an internal shift from an uptrend. And the uptrend was the price action that caused the market to fill the high time frame supply, turning it into a likely upcoming downtrend, since the price has shifted their swing points from having uptrend swing points into now having the first downtrend swing points. So let's finish the analysis. Since the last swing point is a lower low and we've entered into a downtrend, the next swing point needs to be a lower high. That lower high is seen as a pullback to the upside that needs to end below the last high. And again, the level it usually ends at is on a supply or resistance. And that supply or resistance is taken from the last high. And that level is the last upside candle before the market started going down. And this is not only a supply, but it's an internal one. It's a low time frame supply that is inside of a high time frame supply, and the next pullback should end as a lower high. And that lower high needs to end inside of the internal supply, before eventually rejecting back down into breaking the last low. Now that the analysis is done, we can get into the planning of the setup. And that is a sell setup with an expectation of a lower high ending on the internal supply. The entry is placed on the bottom of it, basically right when the price enters inside of it. The stop loss is above last internal high, which should also be above the internal supply. The take profit structurally makes the most sense being placed below the last internal low, since we've already said there's a high chance of an internal lower low. And that's not predicting. It's really just following what already is proven to happen before, which is holding a lower low swing point on a downtrend. Now the price has hit into the internal supply. This opened the sell setup. And the next few candles are already starting to show downside rejection. This rejection keeps going, and eventually it hits the take profit target. This was a quite rare setup. A 1 to 5 is not easy to find, but it can be done. And now coming back into the initial time frame, on the daily chart, what happened on the high time frame is that the price pulled back into hitting the high time frame supply from where it rejected back down into breaking the last swing low, holding a lower low swing point. And what we did with the time frame confluence is that we basically traded this push to the downside, which was the rejection that we found on the low time frame. We essentially aligned both trends together, the high time frame for the analysis and the low time frame for the analysis and execution of the setup. This is still on the NASDAQ, but this time we're starting from a lower initial time frame. The steps are still the same. We always begin a directional analysis on a high time frame. And on this analysis, we care about knowing the swing points the market has been forming, because if we know the swing points, then we also know the trend the market is following. If we look at the swing points from the beginning, we start from a low that climbs up into a high. From this high, the price pulls down and then it continues going up, breaking the last high. So far, the market is an uptrend since we're having coupled uptrend swing points. But this uptrend was shortly lived because from this last higher high, the price fell down super aggressively. And the most important part of this fall down is that it has broken below the previous low, which was a higher low. And so if the higher low broke down, that means that we got a low that's lower than the previous one, forming a lower low swing point. The first break below a low is a structure shift, a trend shift from the previous trend, which was an uptrend, into a highly likely upcoming downtrend. On a downtrend, after a lower low is created, a lower high should be the next swing point. The lower high is seen as an upside pullback that ends below the last high, and as I said on the last market, the level that pullback will usually end at is on a supply or resistance taken from the last high. That should be around this candle. But we see that the next pullback didn't manage to get into the supply, and it ended below it, marking a lower high that was far away from the supply, just for the next action to be a push to the downside that has broken down the last low, continuing the downtrend pattern. Now because the supply did not fill, and we already got another structure of a downtrend, basically a lower high that is then followed with a lower low, and the lower low should then be followed with a lower high, and that lower high is an upside pullback. And this pullback should end on a supply or resistance taken from the previous high, and the supply is the last upside candle before the market started the downside impulse that caused the break below the low. Now when the pullback hits the supply, we switch into a low time frame to look for a rejection on the internal price action. Now we've switched into the 15 minutes time frame, and here we see the exact moment the price has hit the high time frame supply. So if you remember from the last market, when we switch into that low time frame, we analyze the price action that led the market into hitting the supply. And what we can see is this aggressive upside impulse that's then followed with a very small pullback to the downside. And this pullback is finally followed with a continuation of the internal uptrend on this 15-minute time frame. Continuation by breaking the last high. Now we are not looking for a buy setup. Even if this price action might hold this bullish pattern, the reason for that is that we are inside of a high time frame supply and the price can reject down at any moment. What makes more sense is to wait for the price to take down the last low because the break of the low indicates a trend shift into a downtrend, which works in confluence with the high time frame supply, which is also indicative of a downtrend. Here we see that it is broken down below the low, but be careful because this is not a valid break since it has happened with a wick and not with a candle. A valid break happens only when the price breaks and closes with a candle, and not with a wick. Now we notice that the price keeps going up for a few more candles, but then it drops down and this time it did break with a candle closing below the low, and the first break below the last low when the market was previously in an uptrend, that break shifts the uptrend into a downtrend. On a downtrend, we have a lower low, that is then followed with a lower high. That lower high should end on a supply taken from the last high. So we look at the last high and the supply is the last upside candle before the market pushed down, and that level should be exactly on this candle. Now we can get into the planning of the setup, and that's a sell setup with the entry on the internal supply. The stop loss above the last high, and that should also be above the internal supply, and the take profit below the last low. Now we see in this case that if we keep it right below the last low, the risk reward is not worth it. When the ratio is lower than 1 to 2, we should look for better targets. The easiest solution is to just place the take profit on a 1 to 2 or 1 to 3. And that's because in this specific case, we can't really target the extreme swing low because the risk reward now becomes way too high, and these kind of setups are not sustainable in the long run. So we keep it between 1 to 2 or 1 to 3 or so. In this case, it's a 2.5, which stands all right in that range. Position gets open, but this is a quite large bullish candle, got very close to the stop loss getting hit. And this actually turns into a losing setup. So this internal downtrend from this 15 minutes time frame got invalidated. Basically, the price continued to break the last high. This increases the risk of the high time frame supply breaking and invalidating. Let's check back into the high time frame. So we see the price pulling up into the supply, but the price looks like it is not rejecting back down. And it actually keeps going up until eventually it breaks the last swing high, which was a lower high, and it turns it into a higher high. So normally, this would be a trend shift into an uptrend. We had here a lower low that was then followed with a lower high. This lower high then again followed with a lower low, but this last push to the upside has caused a higher high. But even if this trend could have reversed into an uptrend, I would not look for buying setups. And that's because you really need to look at where the price is sitting right now. If we look at it, it has hit the other supply from above, supply that was not invalidated since the price didn't yet break above it. And we try again to switch into a lower time frame the moment the price has hit the high time frame supply. It's still the same low time frame as we had on the previous setup, which is the 15 minutes one. And when we have switched into the low time frame, we do a directional analysis of the price action that caused the high time frame supply to get filled. We start from a push to the upside, followed with a downside pullback, continued with another push to the upside, then another downside pullback. And now currently the price looks like it's starting another upside action. It continued going up and broke above the last high. Now, as I said, we don't look for any buying setups because we're inside of a high time frame supply. But we also don't look for any selling setups since the price action is still having uptrend swing points. The downtrend begins only if the price can break below the last low. Unless that happens, we do nothing about it, but just wait and have patience. Now eventually, the price finally breaks down below the last low. So that should be a valid trend shift from an internal uptrend into an internal downtrend. On a downtrend, after a lower low, we should see a lower high. And as I've said many times, that lower high will usually end on a supply or resistance that was created on the last high. That should be around this candle. And this is an internal supply, being the supply from the 15 minutes time frame, which is inside of the supply from the 4-hour time frame. Now for the planning of the setup, we enter with a sell position from the internal supply, with the stop loss above the last internal high, which should also be above the supply from the lower time frame, and the take profit should be placed below the last low, but in such a way to get at least 1-to-2 ratio or 1-to-3. I would not target for more than that. For example, below the other low, the risk-reward ratio can get way too high. Around this level, we should have more than enough. It's 1-to-3 in this case. So after the market pushed down and broke the last low, the price is pulling back to the upside, and this pullback has hit into the supply. And after that candle, the price rapidly rejects down from the supply. This rejection should break below the last low. If it can close with a candle below the last low, then chances are we will be getting a continuation of this downtrending price action. But if it only breaks with a wick before it pulls back to the upside again, then it increases the risk of this setup turning into a losing one. But fortunately, the price has eventually closed below the last low with a candle below it, and this pushed the market down into the take profit target. Now if we switch back into the high time frame, on the 4-hour chart, what we basically did with the time frame confluence is to identify this rejection right here, but doing so on a low time frame, essentially seeing the exact moment the price started pushing down from this supply. And on the program from the description, I get into complex details on this concept, with a final goal of not only sniping your setups, but most importantly, not losing your wins back to the market.